Okay, so you're staring at your investments. Maybe you've done some digging, got some ideas, but actually deciding, how to put that money to work, how much goes where. That's tricky, isn't it? Especially when the market feels like it's constantly shifting under your feet.
Absolutely. Yeah, that feeling of uncertainty.
Yeah.
It's exactly why portfolio optimization is so, well, powerful. And you might hear that term and think, oh, that's just for the big Wall Street firms, right? But the basic idea, making smarter choices with the info you have, that's relevant for, well, pretty much anyone investing.
And that's our focus for this deep dive. You, the listener, sent over a great set of sources all about the newer ways to think about portfolio optimization. So our job today is to really pull these apart, find the core ideas, and hopefully make navigating those decisions feel a bit less overwhelming and maybe a bit more confident.
Yeah, and what's great about these sources you sent is how they really push beyond the, let's say, the older, maybe slightly too simple methods. We're going to dig into approaches that tackle that forecast uncertainty head on and look at risk in a more sophisticated way.
Okay, let's jump in then. So the classic starting point is usually mean variance optimization. What's the gist of that?
Right, so mean variance, at its core, it's trying to strike a balance. You want the best possible expected return for your investments, but you need to balance that against the risk you're taking. And usually that risk is measured by variance or volatility, basically, how much your returns might swing up or down. So the goal is get the most return for the level of risk you can handle, or take the least risk for a return target you have in mind.
Seems logical, maximize good stuff, minimize bad volatility. But the materials you sent, they point out some real drawbacks.
They do, yeah. Mean variance is, well, it's elegant in theory, but it leans on assumptions that just don't always match reality. Like, it assumes investors only care about the average return and that volatility number, which isn't quite how people think or how markets truly behave sometimes.
And the big one seems to be how sensitive it is to the inputs, like the forecasts for returns and risk.
Exactly. That's a huge point. The beat high robust source you sent really zeroes in on this because let's face it, predicting the future, it's always going to have errors. So you feed these slightly off predictions into a standard mean variance model, and you can get what the source calls pretty accurately unrealistic portfolios.
Unrealistic how? Like they put all your eggs in one basket or they just flip-flop constantly?
Both, potentially, yeah. They can be super sensitive. A tiny change in what you think an asset might return could drastically shift the whole recommended portfolio, and that leads to lots of trading, high turnover, more costs. It eats away at your returns. So yeah, it looks neat mathematically, but it's brittle. It relies too much on forecasts being perfect, which they never are.
Okay, so if that traditional method is so shaky because forecasts are uncertain, what are the better alternatives? What do the sources suggest?
Well, one big area is robust optimization. The name kind of gives it away, right? The main idea is to accept that our forecasts aren't perfect. So instead of just aiming for the best based on one single guess, robust optimization tries to build a portfolio that still does okay, even if the worst plausible scenario within a certain range happens.
Okay, so it's less about pure optimism and more about building in some resilience.
hmm
How does that work, practically speaking?
You basically define a zone of uncertainty around your initial estimates. Your source mentions specifying the covariance matrix of these estimation errors, which is kind of like mapping out how your forecast errors might be related. And you also define the size of that uncertainty zone. They call it K. How much doubt are we allowing? Then you optimize for the worst possible outcome within that zone. The idea is to be less vulnerable to those forecast mistakes. The source even suggests using backtesting, looking at past performance, to help figure out what that covariance matrix and that uncertainty level K should be.
Hmm, interesting. So by planning for potential negative surprises within that range, you might get a portfolio that's maybe less aggressive, but more stable.
That's often the result, yeah. And what's really neat, one source points out that considering this alpha uncertainty, the uncertainty in your return forecast can actually lead to more diversification, especially if you base that error covariance matrix on individual asset volatility. The optimizer kind of shies away from putting too much faith in assets with really high but maybe uncertain expected returns. It prefers to spread the risk.
Okay, so it's hedging its bets a bit more.
Exactly. So we're getting beyond just trying to make better guesses. Your sources also dig into rethinking how we even define risk itself.
Right, that's a great point. The sources argue we need to look beyond just variance. Why is variance maybe not the whole story for risk?
Well, variance is neat mathematically. It measures the spread. But it treats upside surprises and downside surprises the same. And we know intuitively, right? Losing money hurts way more than making the same amount feels good. That asymmetry is important. Plus, real investment returns often don't follow that perfect bell curve. You get skewness, maybe more nasty surprises than good ones, and fat tails, meaning extreme events happen more often than the simple model predicts.
So we need risk measures that actually reflect how investors feel about losses and capture those weirder market dynamics.
Precisely. And one source introduces BIDA GO game loss optimization. Instead of balancing return and variance, GLO looks directly at expected gains versus expected losses, and it factors in loss aversion, how much you hate losing. The source contrasts it with something called the omega ratio, suggesting GLO might model individual preferences better because it doesn't assume returns are normally distributed. It can handle weird shapes.
Okay, so GLO is more focused on maximizing the good stuff relative to the bad stuff, and it lets you dial up how much you really want to avoid that bad stuff.
You got it. And it gets even more layered. A source talks about combined utility functions, like maybe we're not totally sure if mean variance or GLO is the perfect model for a given investor, so why not blend them, give some weight to each? This idea, referencing Bra, acknowledges uncertainty not just in markets, but even in defining our own goals perfectly. It ties back to prospect theory, too, which really highlights that psychological gain-loss asymmetry we mentioned.
This is really getting interesting. We're not just tweaking inputs, we're fundamentally questioning the objective of the optimization itself. Okay, let's talk practical applications.
Yeah.
What advanced techniques pop up in the sources?
One really practical one is multi-goal optimization. The Windham Portfolio Advisor, WPA, is used as an example. This isn't just about one target like return versus risk. It juggles multiple goals at once. Specifically, it looks at your portfolio's absolute performance and its performance relative to some benchmark, like an index.
Ah, so it's like saying, I want good overall returns, but I also don't want to lag too far behind the S&P 500, for instance.
Exactly like that, because investors often care about both, right? You want to do well, but you also measure yourself against something. So the WPA approach essentially combines these goals, absolute return, risk, and maybe tracking error relative to the benchmark into one thing it tries to optimize. It's a richer picture.
That definitely sounds closer to how people actually think about their investments.
Yeah.
What else does the WPA approach bring, according to the sources?
Another big one is within horizon risk. Traditional risk measures often just look at the very end of your investment period. Within horizon, risk asks, what's the chance your portfolio drops below a certain pain point at any time during the investment journey?
Oh, that's crucial. Because even if it ends up okay, a massive dip halfway through could cause panic or force you to sell at the absolute worst time.
Totally. The source uses a nice visual different possible paths your investment could take. Even if only one path finishes below your threshold, maybe several others ditch below it temporarily before recovering. Within Horizon, risk captures that danger zone along the way. WPA uses concepts like first passage time probability to quantify this risk of hitting that loss level before the end date. Much more dynamic.
And the sources also mention risk regimes with WPA. What's that about?
Risk regimes. It's the idea that markets aren't always the same. Sometimes things are calm, sometimes they're, well, chaotic, turbulent. WPA tries to identify these different phases, these regimes, in past data. The thinking is, if you know whether you're likely in a quiet period or a stormy one, you can maybe adjust your optimization strategy accordingly.
So the best portfolio for smooth sailing might be quite different from the best one for riding out a storm.
Makes sense, right? And then there's full-scale optimization in WPA. This is especially handy for assets that don't have those nice symmetrical bell curve returns. Think like hedge funds, maybe. They can have negative skewness, lots of small gains, occasional big losses, and those fat tails we talked about where extreme losses are more likely. Standard mean variance kind of ignores that complexity. Full-scale optimization tries to look at the entire distribution of possible returns, not just the average and spread.
So it's seeing the whole landscape of possibilities, not just a couple of summary stats.
Exactly. It tries to directly maximize the investor's expected utility, however that's defined, considering all the bumps and weird shapes in the potential outcomes. The source notes this can lead to very different portfolios than mean variance, especially if the investor really dislikes those big potential losses.
Wow, okay. That's a lot, but it really shows how the field is trying to get more realistic. The sources also mention some of the math tools, like second-order cone programming. SOCP. Why should we care about that?
Well, SOCP is basically a powerful mathematical engine. It's a technique that lets computers efficiently solve many of these more complex optimization problems with different kinds of constraints on risk or allocations. Your source highlights that SOCP enables using these more sophisticated models for returns, risk, and investor preferences. It makes the advanced stuff actually computable in practice.
Got it. So it's the tool that makes the complex theory workable. And what about constraint elasticity? Sounds like something from physics or economics.
It is, yeah, borrowed from economics. It basically tells you how sensitive your optimal portfolio is to slight changes in the limits you set. Like, say you have a rule. My tracking error compared to the benchmark can't be more than 3%. Elasticity would tell you how much your expected return might change if you nudged that limit up to 3.1% or down to 2.9%. It helps you understand the real impact of your constraints, which rules are really binding you, where might a little flexibility help most. Table 2.2 in one source gives an example.
Oh, okay. So it helps you see the trade-offs you're making with your rules.
Exactly. Helps you understand where the pressure points are in your setup. The source even suggests you could use it to find other interesting portfolios just by tweaking constraints slightly.
And one last bit on practical stuff.
Yeah.
Using a second risk model. Why do that?
The idea, according to your source, is that sometimes adding a second, maybe simpler risk model alongside your main one can actually boost performance, provided you calibrate it right, of course. The goal is often to have both risk models actively shaping the final portfolio. Like maybe your main model is complex and the second one focuses on a specific risk type, like one from a factor model. It can act as another layer of control or robustness, but the key is tuning it so both models are actually doing useful work together.
Right. Okay. Let's pivot slightly. We need to talk more about those messy market realities returns that aren't nicely bell-shaped and the unavoidable fact that our estimates are, well, estimated.
Yeah, absolutely critical. We touched on it, but real-world returns, they often have those heavy tails. Extreme events, good and bad, happen more than you'd expect from a simple model. And volatility clustering, rough patches tend to stick together, and calm periods do too. It's not random minute to minute.
So how do the models try to grapple with that?
Your sources mention a few things. Factor models and copulas. Copulas are a pretty sophisticated way to model how different assets move together, especially during extreme events. They let you separate the dependent structure from the individual asset behaviors. It helps you build more realistic scenarios that capture how things might go wrong across the board, not just for one asset.
A more realistic simulation of potential market chaos, then. And what about evaluating performance when returns aren't normal? The Sharper ratio uses standard deviation, which might miss the point.
Exactly. Sharp ratio can be misleading with skewed returns or fat tails. So your sources introduce alternatives like the Rachev ratio or the Rachev higher moments ratio. These are designed to be more sensitive to asymmetry and extreme events. They might be better suited for investors who aren't just purely variance averse, maybe someone focused more on capturing upside or strictly avoiding large losses.
And another term that came up was expectile value at risk, EVAR. What's that about?
EVAR is another way to measure risk, a coherent one, which has nice mathematical properties. Unlike the more common VAR, or value at risk, EVAR is sensitive to the severity of losses in the tail, not just the probability of hitting a certain loss level. It uses a weighting system where you can choose how much emphasis to put on those really bad outcomes. So it's adaptable, especially when markets get choppy. The source even outlines a potential algorithm using EVAR for allocation.
So it's like fine-tuning your sensitivity to the really big potential drawdowns.
Precisely. Especially useful when standard measures might understate the real danger. Now, completely switching gears for a second, your sources also mention threshold accepting. That sounds less like pure math.
It is, yeah. Threshold accepting is what's called a heuristic. It's more like a smart trial and error approach than a direct mathematical solution. It's good for finding a very good, though maybe not mathematically perfect, solution when the problem is super complex, lots of constraints, weird objectives.
It's described as being pretty robust, meaning it doesn't get thrown off too easily by the starting point. So for really messy, real-world optimization problems, heuristics like this can be a practical way forward.
Okay, so a pragmatic tool for complex situations.
Exactly. Offers flexibility.
And finally, we have to circle back to the elephant in the room, estimation error. Our inputs, expected returns, volatilities, or guesses. Your sources mention Michaud's work here quite a bit. What's the key takeaway on input uncertainty?
Right. Michaud's work is foundational here. He basically showed, quite convincingly back in the late 90s, that standard mean variance doesn't just use forecasts, it actually tends to amplify the errors in those forecasts. You end up with unstable portfolios that chase noise rather than signal. His fix was resample deficiency, or averaging simulated optimization. Basically, run the optimizer many times with slightly varied inputs, simulating the uncertainty, and average the resulting portfolios.
But the sources hint that averaging isn't a silver bullet either. There are critiques.
Yes, exactly. While the intuition of averaging seems sensible, smooth things out later research, mentioned in your sources, questioned its theoretical basis and whether it always helps. Averaging portfolios derived from potentially flawed inputs might just give you an average of flawed outcomes. So, what else can we do?
Bayesian updating comes up. How does that work in this context?
Think of Bayesian methods as a formal way to combine what you already believe your prior view with new evidence. So you start with your initial forecasts, your priors, maybe based on historical data or analysis. Then, as new market data comes in, you use Bayes' theorem to update your forecasts. This updated view, this posterior distribution of returns, is then fed into the optimizer. It's a way to systematically learn and adapt your inputs.
Makes sense. Learning as you go. What about the data reweighting techniques mentioned?
Right, things like geometric or hyperbolic weighting schemes. This is another way to handle historical data, especially the fact that the recent past might be more relevant than the distant past. These methods give more weight to recent data points when estimating things like volatility or correlations, and gradually less weight to older data. It's trying to make the estimates more responsive to current market conditions.
So lots of ways to try and make our inputs smarter or acknowledge their flaws. One last optimization technique mentioned was conditional value at risk, or CVRR. How does that fit in?
CVRR, we touched on it with EVAR. It's a downside risk measure. VAR tells you, say, there's a 5% chance of losing at least X dollars. CVR goes further. It asks, okay, if you're in that worst 5% of outcomes, what's your average loss going to be? It measures the severity of the tail risk. Your source notes that optimizing using CVR can be really useful when returns are skewed again, think hedge funds or option strategies. Focusing on the average bad outcome can lead to more conservative choices than just using variance.
And practically, how do you optimize using CVR?
It usually involves generating scenarios, potential future paths for your investments. These could come from historical data, simulations, maybe incorporating specific market views. Then the optimization finds the portfolio that minimizes that expected loss in the worst scenarios, the CVRR, usually while still trying to meet some return goal.
Wow. Okay, this has been a really comprehensive journey through modern portfolio optimization. We've definitely moved way beyond just risk versus return.
Absolutely. I mean, the big picture is that the field has evolved hugely to tackle the flaws of the basic mean variance approach. We've seen methods that embrace uncertainty, use more realistic risk measures, consider multiple goals, account for weird return patterns, robust optimization, GLO, WPA, EVAR, CVR, even the heuristics like threshold accepting. It's a much richer toolkit now for dealing with messy reality.
And I think for you listening, the main point from digging into these sources is realizing there's this whole spectrum of sophisticated tools out there. You can go beyond simple models to make potentially more robust, more tailored investment decisions based on whatever information and forecasts you have access to.
Definitely. And maybe a final thought to leave you with. Given all this complexity, all these different ways to define risk, to handle uncertainty, to set goals, what do you think is the most crucial piece for getting optimization right for your own needs? Is it nailing the risk measure, dealing with forecast error, or is it really about making sure the entire process aligns deeply with your personal financial goals and how you truly feel about risk? It's worth thinking about and definitely worth critically examining the assumptions behind any strategy.
A great point. This field is always changing, always looking for better ways to manage risk and reach financial goals. We hope this deep dive gave you some valuable insights into where things stand today and the kind of thinking that drives modern portfolio management.